In addition to all the tit-for-tat tariff one-upmanship that's been going on for the past week or two, and the Doge cutting of government spending, there's been something else that's happened that's been a seismic shift in global geopolitical politics. Now we're feeling the symptoms of that today, with the stock market taking a tumble and gold breaking $3,000 an ounce. In this gold market commentary for Friday, March 14th, 2025, I'm going to discuss the root cause of this seismic shift, explain why it's so fundamentally important to all of us, so that we can all understand a little bit better what may happen going forward. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. Now, when Donald Trump became president, he inherited a bloated U.S. government loaded with fat and debt and deficits. And the work to cut this fat out of the finances of the government is hard work. And it's going to be a bitter pill for all of us to swallow. And there's a couple of reasons for that. Our budget has become so bloated and our deficits so large that if we don't correct them, we're headed for disaster. And Donald Trump knows this, and he's also on a very short timeline to accomplish his goals. He's got about 19 months before the midterm elections. And under normal circumstances, any president that's been handed all three branches of government usually loses one, if not both, at the midterms. And based on the massive changes that President Trump wants to make with our government and the pain that we're going to have to endure before we can achieve the gain that he's trying to accomplish, if that's not accomplished before the midterms, we will go into gridlock, and then all of this will be for naught. So he's on a mission. And I think we're all seeing how fast and how furious he wants to change things now. The last time we had a balanced budget was when Bill Clinton was president of the United States. And over an 8-year period, he used a scalpel every year with the budget to cut out a little bit of pork here, a little bit of fat there, so that by 1998, the U.S. achieved the first balanced budget since 1980, maybe earlier. And we had one in 99, and it continued under the Bush administrations in 2020 and 2021. But Donald Trump is hitting the ground running, and Elon Musk has got a chainsaw. And it's not always the best thing to do to attack the patient with a chainsaw. And that's why we're going to feel a lot of pain. What President Trump is trying to accomplish may not be doable by the time we get to the midterms. So time will tell. And that's why we're going through all these market gyrations. But the biggest seismic shift that I've seen in my 50 years of watching the presidents personally and studying back to World War II has just occurred. And it happened when Volodymyr Zelensky came to the White House on February 28th, and he and President Trump had that very public blow-up. Now imagine that you're a parent with children, or you're an older brother or sister with younger siblings. It's your job to protect them. So if a bully comes around, you put your arm around him and say, hey, I'll protect you. I've got your back. Well, since World War II, that's how the U.S. has been with Western Europe and other democratic nations around the world, countries around the world. We've stood up for democracy's sake. And what President Trump indicated at the conclusion of the Zelensky meeting was, hey, good luck, you're on your own. And this has created a seismic shift in international relations. And it's also caused a seismic shift in how the protection of the Ukraine is going to occur going forward, if that's going to happen. So economically, war is big business. And the U.S. arms manufacturers occupy about 43% of the global world arm manufacturing capacity, according to Tracy Schuchart, who put up a great chart on X the other day. 43%. And about 10% or a little bit more of our capacity goes to the Ukraine. Well, if we back off on that, that means we're going to be spending less money with our own arms manufacturers. So that's less stimulus for the U.S. economy. And Germany and Great Britain, who are the two primary European suppliers of armaments to the Ukraine, are going to have to pick up the slack. And that means they're going to have to stimulate their economies because both of their economies are very weak, at or near recession. So they're going to have to deficit spend. And as we've all learned over the last 20 years, stimulus gets you a better economy. A lack of stimulus gets you a worse economy. So that's the fundamental equation financially that has shifted since the Zelensky meeting, right? The US is going to contract a little bit, and Europe could potentially expand a little bit. Now, when you look at the US economy and US economic exceptionalism, which has occurred over the last 2 years, where the US economy has performed better than every other economy around the world, you can understand why our markets are so valuable today, or why they have been so valuable and overvalued in some aspects compared to the rest of the world, which has been beaten down. Well, now you've got a change in policy with the US that fundamentally means we're going to have a little less stimulating economy, a little less stimulatory economic effects here, and a bit more in Europe. So what have we seen? We have seen the dollar plunge on the US dollar index, which means dollars are leaving the country. They're being sold to go elsewhere. We've seen the British pound go up about 3% against the dollar in the same time frame. The euro go up about 5%, and the yen go up about 6%, all in 1 week or so. And these are seismic movements of currency. And some of that money has also come out of our stock market. So that's why we're feeling these major shifts right now. And it's also helped to buoy gold over $3,000 an ounce and silver into full-on breakout mode. And that's the real root of the problem, is this change in administration behavior. Now, whether it's just a negotiating tactic or a more fundamental driver, we'll have to see. But I understand what President Trump is trying to accomplish, because Russia is an oil producer, and we've sanctioned their oil and tried to push it off the market. And he knows that if he wants to bring down inflation, he needs to bring down energy costs. He's told us that. So that's why he's pushing so hard for peace in the Ukraine. I have a hard time believing that he's going to be able to drive that equation, because Vladimir Putin of Russia is really sitting in the driver's seat. He's just retaken the Kursk region. He's taken most of the Donbass region, which is what he wanted as a buffer. And his forces are winning. And now the adversary that's helped his adversary the most, the US and Ukraine is backing off a bit. So why would he want to accept our ceasefire proposal? He didn't. He just rejected it. And I think that this war will be settled on his terms. It's probably going to get settled, but they'll be on his terms. If the Ukraine will stomach it, and if we'll allow it, and if Great Britain and the Eurozone will allow it as well. We'll see, but that's the bigger picture. But in the meantime, our markets have tumbled, stock markets have tumbled, and primarily the dollar has really taken a big fall. And it may be possible that this is the beginning of the end of US economic exceptionalism, meaning we're going to outperform the rest of the world. We may catch up to them by going back down. And over the last week or so, with the one-upmanship of tariffs between Canada and now the EU over alcohol, it's just continual ratcheting of one-upmanship. I really have respect for President Sheinbaum of Mexico, who has been the most diplomatic trading partner who's had sanctions enacted on them. You know, you really don't want to see diplomacy conducted in public. You don't want to see the sausage being made in the sausage factory in case it gets dropped on the floor. And that's what happened 2 weeks ago in the White House meeting between President Trump and President Zelensky of the Ukraine. The sausage got dropped on the floor. And we created a seismic shift in US presidential doctrine going back to Harry Truman post-World War II. So let's see how this is all playing out in the marketplace. Let's take a look at our charts. Let me share my screen and get on with my presentation. This is a 1-year US dollar index chart. Now, when I updated you last, it was Friday, February 28th, while the Zelensky-Trump meeting was going on. And I indicated at that point in time that the dollar looked like it could weaken as a right shoulder of a head and shoulders formation was starting to form on the chart. But as you can see, the dollar has plunged from 107.50 all the way to 103 or under in the following week to 2 weeks. Most of that occurred during the first week for an almost 4% loss. This is seismic for a currency. If we look at a 6-month daily candlestick chart, you can see more granularly how the dollar was rising going into the Zelensky meeting, and then the following Monday, the dollar really started its plunge. And this is money fleeing the US, whether it's foreign money going back home or our own money moving to places where there might be more opportunity now. We don't know, but it is big money moving out of the US, selling dollars and going into other currencies like the euro, the yen, or the British pound. Here's a 2-month daily candlestick chart that shows you the same thing more granularly, which is more dramatic. This is a gigantic plunge in the dollar in just 1 week. Here's the British pound up 3% in a week. The Japanese yen up almost 6%, and the euro 5.2%. So that's where the money's going. It's leaving here and it's going there. But it's also leaving our stock market. This is a chart of the Dow. And it shows you how the Dow was rising the day of the Zelensky White House meeting, and then it's done nothing but go down. The first 2 days of trading following the Zelensky meeting, March 3rd and 4th, a big tumble sideways for 3 more days. And then the next week, the tit-for-tat tariffs started to really ratchet up, creating more and more uncertainty over what's going to happen with the US economy. And that's what's led to the second leg down in the Dow. But it's not just the Dow, it's also the S&P 500 and the Nasdaq. And this has got everybody's attention in the US. But this has also helped to propel gold higher. Gold does well under times of economic uncertainty, which we're certainly facing, and also when the dollar weakens. Gold was starting to go into a major corrective phase following a big run from early December all the way to late February, from about $27.50 to $29.63, a $210 run. Then the frost started to come out of the market and we started to really correct. Now, under a normal correction, gold would have fallen to about 2,800, maybe 2,750. When I updated you last, it was 2,840, and that's what I told you. That's where I thought it would actually go. But following the Zelensky meeting, gold caught a bid. It punched higher, rolled over a little bit, and then on the back of all this tariff uncertainty, it surged over $3,000 an ounce for the first time ever. If you look at the daily 6-month US dollar index candlestick chart just quickly, you can see how it plunged. And now correspondingly to that, to the gold candlestick 6-month chart, you can see how gold responded. It went up instead of those purple ticks down that I have drawn in to where I thought it would go. Then we went sideways, and now more tariff uncertainty has brought gold up to over 3,000 as of the close of business yesterday. We're a little higher today. We've got an intraday high in the futures market of $3,017, with the spot market breaking over $3,000 for the first time ever today as well. So the gold market is benefiting from this weaker dollar. And if these trends continue, we'll see the equities markets fall further, and we'll see gold and silver benefit. And let's take a look at silver. Here's a 1-year silver chart. And as I indicated conversely to the dollar last time, it looked like silver was in an inverted head and shoulders pattern. When I talked to you last time, silver was right at about 31.50 at the bottom of that inverted right shoulder. And now you can see silver has punched all the way up to 34.25 as of the close of business yesterday in the futures market. It's actually got closer to $35 today in the futures market, so it's gone even higher today. And this is testing It's not testing. This is a true breakout. The previous short-term high is from last October when it got to 35.04, and that's in sight right now. Silver breaks over that, it could go to $40, $45 very easily, and we are in that phase right now. So here's a 6-month candlestick chart that shows you how silver responded following the Zelensky meeting. Just like gold, it firmed up, it corrected a little bit, and then the tit-for-tat tariff one-upmanship over the last week has punched it up. And we've got one more candle off to the right that's not on the chart, that's even higher than the $34.70 intraday high we're showing from yesterday. So silver's in a full-on breakout. It's playing catch up a little bit to gold. And this is one of the reasons why I am so fundamentally excited about silver right now, is the fact that unlike gold, which central banks hold large positions of physical gold of, they don't hold correspondingly large physical positions of silver. So the shock absorber in the physical marketplace for silver is dramatically less than it is for gold. And we're seeing that in the London Bullion Market Association supplies. Now, some of this has moved into the COMEX exchange, but a lot of this is going to end up getting used in industry because silver is 50% monetary and 50% commodity metal. And as you can see, the overall stockpile of silver in the London Bullion Market Association warehouses has dropped about 40% in the last 4 years, where gold has only dropped about 13%. And this is one of the reasons why I think, hey, silver may be not only attempting a breakout because of what gold is doing, but the physical shortage of silver may lead to a true breakout even higher as well. So silver's got really strong fundamental potential right now, and that's starting to show up in the gold to silver ratio chart. With the spot gold price today at about $29.90 and silver at $33.90, we've got the gold to silver ratio at 88.2 to 1, which is about 2 full points below where it was 2 weeks ago, which means silver is still undervalued, but it's starting to narrow the gap with gold. And if silver makes a big run, like is very possible in the very near future, we could see this gold to silver ratio narrow sharply. You can see last October when when silver made a run, it got down to about 79 to 1. Last spring, we saw the ratio at 73 to 1. We could see a similar range for silver now in the mid 70s, the way things are going. So I really like silver right now. We do have a Canadian silver maple leaf special. We've got a new tranche that we just bought today. While the silver price is higher, the silver premium is a little bit lower on this deal. Today, we're as low as $1.99 over spot, which is as low as we've ever been able to offer backdate silver maple leafs at. So this is a great opportunity to add physical silver to your position if that's what you'd like to do. So that is our update. Thank you for your time. Now, my job is to offer to you factual, accurate, timely, actionable information. So if you like what we're doing, please subscribe to our YouTube channel, like this video, tell your friends. And as always, thank you to our loyal clients who've placed trust in us for the last 27 years. Without your loyalty in your business, we wouldn't be in business today, and there isn't a day that goes by that we aren't grateful for everything that you've done with us over the last 27 years. So thank you, have a great week, and good luck out there.